What do you think about these markets?
Are the owner-occupiers also buying in those areas, and what's the percentage there?
Devonport will get ruled out on your list always then?
It is my risk mitigation strategy, which is why I would exclude it, but it's related to the investment time horizon.
Is there actually room for further growth?
What is the time frame that the higher levels of infrastructure spending will affect the purchasing power of residents?
These are some of the hottest markets in Australian property right now. It's the markets that every buyer's agent is looking at, and we're going to unpack them with one of the smartest data minds in our industry. I've got Dr. Matt Jolich here with me today again. He's been on this podcast before, and we're going to pick his brain on these 5 locations specifically. We're going to go through Devonport in Tasmania, one to watch. We're going to go through Bendigo, Geelong, Darwin, and Albury. These are the markets that property investors are jumping into right now, and we want to get his take on them. Matt, how are you?
Good, man. Thanks for inviting me again. I mean, as you know, I love discussing data and markets, so I really appreciate the invite.
Yeah. One of the big upsides here is these markets that investors are in right now, on our phones, the reason why they're jumping in here is because of data reasons.
Mm-hmm.
Sydney property investors and Melbourne property investors aren't going to Devonport in Tasmania randomly. They're going there because either a buyer's agent has told them that this is an area that we're looking at, most likely using data frameworks to justify their decision, or they believe there's some strong rationale for these markets, which is typically built by information or data or some sort of hypothesis.
Absolutely. Yeah.
So the reason why this is so exciting for everyone is just like, what do you think about these markets? And let's go unpack it using your data tool, the one you built, the one that everyone actually uses, HTAG. It's your tool. You know it better than anyone. And this is probably the tool that's pushing people, or part of the information tools that people are using to actually go to these markets.
Yeah, absolutely. Now, I mean, yeah, you mentioned the term, investors are mainly going there, know. Now the question remains, are the owner-occupiers also buying in those areas, and what's the percentage there? But I mean, I'd love to unpack them. I mean, just as a starting point, these markets that you've mentioned, we're going to look at the LGAs of these markets. Now, there are sub-markets within these LGAs, which is important to mention. I mean, LGA is just an aggregated representation of a multiple of suburbs. But in an LGA, you're going to have suburbs that are performing much better than others, But holistically, we're going to look at them. And let's start with Devonport. I mean, it's interesting. Before I deep dive, there is this phenomenon that appears usually in our shortlisting methodology where when people are trying to, anticipate where the market is going to move, they use this warm spot methodology, And what we usually saw, let's say at the time of Perth, you saw Melbourne areas popping up in the list, or Tasmania areas popping up in the list. And it's like a sign, okay, it's popping up in the list. It wasn't there before. It should be something to look at.
Yep.
And we are currently in a situation where, if you use the warm spot methodology, we see some of the, Tasmania areas popping up in the shortlist. So I think it's timely that we're talking about it. So let's dive into Devonport. Looking at the suburb page right away, I see, not the suburb page, LGA page, and I'll go through it the way I analyze it.
Love it. I love it.
So if you interrupt me, if something doesn't make sense, or if you want me to unpack it. But the first thing that I look at, for example, is I look at the data confidence, and we see medium data confidence in Devonport. What that means is that the velocity of sales is probably smaller than in other regions throughout, a substantial amount of time.
Yep.
Now, again, as I said, this is an aggregated representation of suburbs. That doesn't mean that, let's say, Devonport as an LGA has median confidence. There are suburbs underneath that have high confidence data, But it's the first thing that I look at. Another thing that I look at is we can see that the rents are outgrowing property prices. So we see 11% increase in rents and 7% increase in property values, which is actually very interesting because
is that 12 months?
In the last 12 months, sorry, that's a year.
11% increase in rents.
Yeah, that's right. So we saw rents jump. The yield has jumped 3.4%. The yield has jumped. At the moment, it's sitting at 4.24 gross. So rents have jumped 11% to 473 per week. And the typical price of a property has jumped 7%. It's sitting at 579. Now, what is interesting is that as soon as I look at this, I see that obviously rents are preferred, but you see a migration from renting to purchasing, because as soon as if rents are preferred, you wouldn't see a substantial growth in property values as well. So usually how, let's say, a warm spot turns into a hot spot is you have to have certain elements aligned, but it usually starts with a higher yield. The area has a higher yield that entices investors to come in. They come in, the property prices grow, and then the yield drops,
Yep.
And now usually why, areas have a high yield is because rents were preferred, and while rents are preferred to a certain level where it becomes more sensible to own than to rent, you see a divergence. So what I'm trying to say is that the fact that both are growing is telling me that there might be some migration from preference from, renting to ownership, even though rent is actually outpacing the growth in the last year.
That's normal when there's a double-digit appreciation in the price you pay to rent. That's going to push more people. They're going to get a rental notice and be like, what? It's another $40-$50 a week.
Exactly. And you come to a point where, okay, and you put pen to paper and you say, maybe I should just buy a house, And this is why I said, what is the owner-occupier base saying, not just the investors.
Mm-hmm.
So that's the first thing that I look at. I mean, I look at the RCS scores, which is the algorithm. It tells me about risk, capital growth, and cash flow. They're both below 50, which in my view would usually be filtered out on a suburb level.
Mm-hmm.
So, I mean, risk score essentially talks about industry diversification and inadvertently implies volatility. If the industry is centralized, it is more volatile, hence your annual averages are lower. And when I usually filter, I set it greater than equal to 50. This one is 42. So if I was filtering LGAs, this one would be filtered out, and I wouldn't consider it.
And that's based on the economic diversity of what makes up Devonport's composition.
Correct. So it is the diversity. It's actually a little bit more nuanced. So it's not only the number of industries, but the affluence of industries associated with that number.
Yep.
So is it professionals or is it blue collar workers? So you can consider that, takes that into equation as well, and it takes into equation negative environmental effects, because that's how we classify risk. So looking at that, this will, let's say, fall part out of my shortlist. But again, as I said, it's an aggregated representation. This doesn't mean that some suburbs within, are not investment potential. Going down the list.
And do you have that across? Would I be right to say that Devonport will get ruled out on your list always then, because the nature of an economy doesn't really change all that significantly for long periods of time? So, if the yield had gone up a lot, or if there's a lot of pressure in the Devonport market, you're still going to see that economic composition issue in Devonport.
That's right. See, that's a great question. Now, for example, I said it would fall out of my shortlist, yet it has seen 7% growth in the last year. So people are making money. So it's like making more than an average. Why would it fall out of my shortlist? Well, this all that comes down to timeframes and investment time horizons. So if I have a long-term investment time horizon, I want to sleep at night, I want to invest in an area. This is all about risk elimination,
Yep.
I want to eliminate risk, and therefore centralize my investments in areas that have diversified industries, so they're less sensitive to macroeconomic changes. Like essentially, I don't know, something happens to a single industry, the government is not financing that industry anymore. The workforce diminishes, the purchasing power diminishes, but then you have all of these other industries that are helping out.
Yep.
Imagine, you have a couch with 5 legs, one leg falls off, the couch still stands, So it's essentially that. So it is my risk mitigation strategy, which is why I would exclude it, but it's related to the investment time horizon. So if I have a long-term investment time horizon, I want to eliminate volatility,
100%.
And if there's not enough industries to support the town, if there's a single or two industries, what you'll see exacerbated volatility, which will lower your capital growth averages.
Yes.
Yeah. So to answer your question, if my risk profile was lower, i.e., if my investment time horizon was lower, then I potentially would also consider areas that have higher risk profiles.
Yes.
But those areas would need to deliver substantial amount of returns within that short time frame for me to take on the risk of, potentially what's going to happen. 100%. So yeah.
So that's a brilliant justification there. So I'm going to sharpen that up in terms of the timing of your investment horizon. So if your property plan, and Matt, your software HTAG now, or in conjunction with a partner, now has the ability to give people far more accurate property plans around their own goals, which is really the first step to make before we start talking about
it's setting up your portfolio. Absolutely. Yeah, exactly.
Exactly. So if your portfolio plan is open to taking on a little bit more short-term risk, the chase of a short-term wealth outcome, or perhaps you're going to be purchasing an owner-occupier in a few years and you want less debt on it, and you have 3 or 4 years before you're ready to go make that decision, which I mean many people who are in that framework.
I'll give you many examples of that. Absolutely. Yeah.
So if you're in a framework like that, then the economic diversification of an area can kind of come out of your frameworks of suburb selection if you're open to a shorter time horizon, noting that there's opportunity within these marketplaces as well, like Devonport 7% in a year,
Correct.
11% rental growth. There's opportunity there. And we're going to talk about Darwin soon. It's a gas concentrated market.
Yeah.
I presume it's going to have some similar risks attached to it with its economic diversification. But people can make a lot of money there. But that diversification, the lack of economic diversification over long run time periods, you're going to see lower, or typically you see lower economic growth rates. And most property transactions for buy and hold property investors are over long-term horizons. If you're making a property decision today to purchase a property, typically you're looking, 7, 8, 10, 15, 20 years, not 3. So this really comes down to what frameworks you
Yeah, absolutely. And I have many examples, and you said it right. Like, I have many examples where people want short-term investment time horizon to pay down their PPOR or to minimize the debt, or they want to create a more substantial cash base which they can leverage into a more reasonable purchase. There are many reasons why people might want to trade property. The caveat with that is that when you shorten when you increase the risk, you also place a huge onus on timing.
Yes.
So
which is risky as well.
Yeah, exactly. So, I mean, you need to, if you enter a market that has a single centralized industry, you need to enter a market at the beginning of its, increase, as opposed to, when it's trending down. So there are a few nuances there, but absolutely. Yeah. I mean, to conclude, if my risk profile was lower and my investment time horizon was shorter, areas such as Devonport might fall into my short list. I would only need to assess later, okay, will they deliver me within the 3 or 4 years that I'm planning to hold the asset substantial returns, which would alleviate the sales and acquisition costs and actually leave me with some cash on the sidelines to do what I actually wanted to do.
Exactly.
Yeah.
I'm going to add one little contextual framework for why these markets are popping up. Increasingly, the industry is more and more property investors are using buyer's agents or, advocates to help them actually purchase. Now, the measurement frameworks for success in this industry is becoming shorter. So if you hire somebody and ask them to do a job and their KPI is deliver me a return inside the next couple of years, because if you can prove it, then you're going to get repeated transactions and you're demonstrating results that help me on my journey. That is the KPI framework that exists today when an agent comes in and does it for you. If the KPI framework is you over 30 years, there's lots of time for this to happen, and the results matter at X point in time, 30 years into the future or 10, 15 years into the future. The whole KPI framework is different because your measurement scorecard is a very, very long point in the future, and the cycle could come in later and you could be pre-positioning. So the big interesting takeaway here is the market selection here that has come out. The reason why we're talking about these markets is because they're on buyers agents radars at the moment, and we've picked that up, and we just want to share that with our audience. And we're like, hey, you might be interested. But the reason why that might be there is because of this KPI framework that exists.
Yeah. So you can add to that. Like so I think, buyers agents, rightfully so, that they're in the game of anticipation, because sometimes it becomes very competitive in certain markets to source listings that are, justify the investment, So they need to actually look ahead, and they need to find markets that, will perform in the future, but the entry points are lower. They can discount the property XYZ,
Yep.
So coming back to the KPIs, what is interesting about that observation is that we suffer as human beings from recency bias, and, a good investment, a good choice might be perceived as an area that delivers to you 20%, within the first 2 or 3 years, The question always becomes, what happens after that, So I do want to reiterate it, and why I think it's very important is that, yes, I understand, we suffer from recency bias, but we need to understand our brief, our risk profiles, what we actually want to do, because that's going to affect really the areas that we're going to choose, and essentially set our expectations,
100%.
So, I think that these areas are popping up and I get phone calls every day, literally every day. I had 2 strategy sessions yesterday, and the strategy sessions were simply, Matt, can you teach me how to anticipate where the next market will be? Because they're finding it hard to battle out in Melbourne, for example, or somewhere else, So they're trying to look ahead. But in order to look ahead, you need to sort of know that, these markets that we do delineate as forward-looking, they need to stack up long-term and short-term as well. They can't just be, a pump and dump scheme, if I was going to, use that terminology.
I love what you just said there about the audience all heard that for a minute. It's a little preview to something that's going to come out shortly as well, is what is happening on the ground in Melbourne and some of those challenges that people are talking about, and the conversations you're picking up as well. So we'll share Matt's take on the Melbourne market shortly as well in a different episode. We'll cover that. What else have we got to say about Devonport?
So, the population size and dwelling, I usually don't look at, simply because there's no proof that there's a correlation that higher population leads to more growth. So in a hierarchical arrangement of metrics, I don't consider that first. What I like in this instance is, if I look at infrastructure spending in Devonport, it is close to $4,000 per capita, which is top 0.5% in Australia.
Yep.
So that means that something is happening right away. I can see that there's some development happening there. The only issue, and see, this is, the beautiful thing about combining metrics is, when you have a centralized industry and a lot of infrastructure spending, I straight away ask myself why. Because if it's a diversified economy and there's a lot of infrastructure spending, that is a great precursor to population growth. However, if the industry is centralized, for example, i.e. a mining town, and there's a lot of infrastructure spending, well, that's mainly catering to the project itself as opposed to the growth of the suburb and the population. Yep. So the fact that Devonport has, it doesn't have a centralized industry, it's right on the cusp of average, but it does have large infrastructure investment, which is great. Increased liquidity, more money for people because of the projects that are happening. So that's always a good sign. Then I go further down and I look at the typical price curve of Devonport since 2007. And I always say, you can find information, you need to try and look for information everywhere. This is a simple chart, but what do I see in this chart? I don't see any sharp deviations to the downside historically. I don't see a lot of volatility. It's been going up for the last 3.5 or 4 decades, which means that even though the industry is average when it comes to diversification, it hasn't really impacted the growth of the suburb by way of, substantial downside historically, So I make that as a tick. I like the shape of the typical price and how it's going. And we can actually see that the projection of the cone, and it's been growing recently, the projection of the cone is suggesting it's going to grow further. It has grown 109% in the last decade, which again is inadvertently an indication of stability. If I look now, when it comes to the growth in the last decade, usually what people say, another misconception, I guess, for the audience is if something is going 100% in the last decade, it will not grow more. It has grown a lot already, and that's like saying the sky is blue because it's blue.
I love that line.
It's like, because we need to determine where actually growth comes from. Growth comes from reducing supply and increasing demand.
Yes.
Just because something has grown 100% in a decade, it will grow more if it has a reducing supply and an increasing demand. So when it comes to the 100% growth in the last decade, I mean, in a hierarchical arrangement, for me, that will be a level 3 metric, which will be like the bottom in the hierarchy. But I use it as a proxy for stability. It tells me that, the price has been steadily rising for a decade, which inadvertently implies, I guess, stability, probably potentially longer hold periods, et cetera, et cetera,
The only thing is it right to say that I'd overlay my concern there would be if you're starting to approach some level of affordability cap that looks a little bit off, or is just like, hey, is there actually room for further growth, even if demand and supply is there, but if affordability in a lower socioeconomic sort of area or regional area is so stretched, perhaps that would be
that's a great question, and it's an essential one. We come back to the hierarchy of metrics. Affordability is one of the most important metrics out there, because everything's driven by affordability. And I always try to, with our users and strategy sessions, some people don't connect, and I always try to bring it back to common sense. Let's say, 20 years ago, you could fill up a shopping trolley with $20. Now it takes, $300. So you go to Aldi or the farmer's market, you change your purchasing patterns and behavior. So what that means is that you're right. If, the area's steam can be assessed by where it sits on the affordability chart. If it's very unaffordable now, the question of steam comes into play, because think about this, and this the best, 2/3 of mortgages issued are to owner occupiers, and if the property is unaffordable for the residents that live within, that means that the 2/3 of the purchasing cohort is dropping off as well. So yes, absolutely, that's one, and we'll get to that, but there is a cap definitely on, and I'll give you one interesting nugget of information. For example, for properties that are now sitting at 1.4 million, but have grown 100% in a decade, which means that they started 700. I'm not accounting for compounding or anything. I'm just adding it up, So those properties that are 1.4 million, there are no areas with a disadvantageous socioeconomic standard. So if we talk about the socioeconomics as a metric, it's called ERSAD. It's Index of Socioeconomic Advantage and Disadvantage. It's a score from 1 to 10. So 1 and 2 are disadvantageous areas, which means that, let's say you invest in a 700K town and you want it to double and the ERSAD is 1, there is 0% chance that it will do so.
Wow. And what's the ERSAD of Devonport?
The ERSAD of Devonport on an LGA is 2. Now, the typical price point, and this is where we come down to friction points and caps. So the typical price is 600K, yeah? The typical price is 600K while the ERSAD is 2. Now, this reduces the ability of Devonport to come to 2.1 million in the next decade, but then the question is, where will it reach? Will it stop at 900? Will it stop at 950? Will it stop at 700 and all these other things? And we can determine that from the current affordability levels and supply and demand, and that's how I'll layer it further. We'll get to those. Before we get to those, what's interesting about Devonport, for example, is that if I look at the growth rate cycle and how the growth rate, has been behaving, historically it has seen the lowest level of growth was minus 4.12%, which is standard for Australia. So the downside is minimal historically.
When was that?
It was in 2012.
Okay, cool. Long time ago.
Yep. And the GRC index, which measures how many months an area has spent in the positive growth zone, again, both combine a volatility measure. It's 167 months. So this area spent a lot of time in the positive growth zone, which means that it has allowed the owner occupiers and investors is allowed the, compounding essentially, Yep. Another interesting thing about Devonport, if we look at growth pattern deviation, just think about it this way. It's a fancy term of saying you're comparing the area's growth to itself at different timeframes. So Devonport has grown 2%, 3% more in the last 3 years than 3 years before that. Okay. But it has grown 22% less in the last 5 years than 5 years before that.
Yep.
and it has grown 17% less in the last 10 years than 10 years before that, which tells me that Devonport is on the cusp, potentially, of a new cycle of growth. It hasn't essentially exhausted its steam,
Yeah.
So that's one
you're,
thing.
You're touching on a little bit of like cycle timing there.
Correct.
Right? Yep.
Correct. Now, ERSAT, as we said, the socioeconomics is 2.
Can I get you?
Yeah, go for it.
I feel like in this episode, we're going to talk about a few different areas, but we're talking about frameworks as well for looking at what area is doing really well here. Can you help the audience understand how you came to the conclusion just there after just looking at that price growth trajectory over periods of time in Devonport relative to itself? You came up with a conclusion there, and that conclusion was it may be ready for its next market cycle where it grows again. Implied in that conclusion, you have some knowledge there around market cycle timings in the first place.
Yeah, so
mind sharing how you got there and why you got there.
Yeah. So growth pattern deviation is a metric that's been developed by HTAG. It measures the growth of the area, compares it to itself at different timeframes. So it's like a measurement of steam. Now, we have to start with the premise that everything moves in cycles and nothing grows permanently or nothing declines permanently. So hypothetically, and South Australia is a great example, if South Australia has been outgrowing itself constantly for the last 2 decades, then the question of probability arises. Okay, if it's been pumping and delivering more and outgrowing itself for the last 2 decades, how much more of it does it have? Like what is the question of steam? Will it continue doing so in the future? And the more it has been outperforming itself, the less there's a probability that we'll be continuing doing so into the future. And this is why it becomes very important to actually layer and understand metrics and timeframes to see, okay, what are my expectations, And it's always a question of probability. We never know what's going to happen, but we do know it's a fact of life that nothing is perpetual and permanent. You don't have a perpetual hotspot, nor do you have a perpetual decline. So if something has been outgrowing itself for 2 decades, and if I'm comparing 2 or 3 suburbs and all of them are equal, while one has been outgrowing itself, well, I'll pick the other 2. Just because of the probability, So, it's all a layering thing. But the reason why we developed that is just we wanted to see, because some people have long-term investment time horizons. And it's important for me to be able to give them some information as to what they should expect in 10 years, Does this area have the ability to actually grow so you can actually refinance twice and not just once? These are the questions that are usually asked. And that's why you need these measures and indicators in order to determine that,
Brilliant. Thank you for the explanation. I think you hit the nail on the head with the 2 premises around what happens. Market growth happens in cycles and nothing perpetually declines. Those are like key takeaways for property investors watching this. When you are looking at data frameworks, that is a very, very important foundational knowledge base that you should have. And it should drive some of the decisions you take as well. It makes certain markets, like if I'm talking about Adelaide, for example, just as a off-the-cuff comment, one of the challenges that they have there is an affordability challenge from its lowest yield that it's had on record.
Well, but why has that happened? Exactly, because it's been outgrowing itself for long periods of time.
Exactly.
So the unaffordability increased, the yield dropped. Those are the ramifications of that.
Exactly. And what you see as a result, unpacking the how is less investors start purchasing there because the rental yield is lower, and many investors have these frameworks. So they're like, cool, I don't want to invest in Adelaide anymore. So you start having that market cycle turn because the investors that drove some of that growth are now looking somewhere else. So that's some of the frameworks that you look at. And then also from that affordability price point, right now Adelaide's got the lowest vacancy in Australia, but it also has this could be quarterly and cyclical right now, but it also has lower rental growth rates than you would expect for such a low vacancy, especially when you compare it to the rest of Australia right now. Part of that makes sense because it's reached such unaffordable levels that there is no more room for rental inflation to continue at the pace that it's been going at for the last 5-10 years because it's run so hard. So much knowledge about market cycle timings there.
Yeah, it's if I may just add a few things, and I think it's important for mindsets for investors. Like for example, coming back to the affordability issue in Adelaide, it's not just that it affects investors; it actually affects the owner occupiers the most. And imagine yourself living in an area where suddenly you bought a house for 500K and you just turn around 10 years later, it's 1.2 million. And you're like, okay, what the hell has happened? So not only does it infect investor inflow, but it also affects, the volume of purchasing for the owner occupiers. And those are the two cohorts that buy and drive the price up. But the mindset thing that's very important, and this is, my professor told me, always read widely, and economics as well. It's because everything moves in cycles, you have to be a contrarian, you have to, and contrarian is not a negative term in a sense, it's like a contrarian investment thesis, which is used by Warren Buffett. You have to sort of look ahead and see, okay, knowing that nothing grows indefinitely, when will I when will I enter a market to take opportunity of its lows, which has the capacity to grow further? And I think one other important thing that investors deal with, that I deal with on regular basis, is that, we all like to see our bank accounts increasing, in numbers, we like to see them grow, and then you get this emotional connection to the growth. There's a psychological element to it where this is why gambling exists. There's a psychological element to it that you think, okay, this will go on forever. It will not go on forever. And Perth is a great example. I knew Perth, and by the way, there are great markets in Perth that you can invest now, depending on your strategy. But what I'm saying, I'm talking about the mindset. It's like when it's growing for 4 years and you've made 100 or 150% returns, everyone is shouting from the mountaintops that Perth is the best investment location. For me, it's a sign of exit. I mean, if anyone's traded in shares or equities or any other asset class, as soon as you see, let's say Bitcoin, as soon as you see everyone talking about Bitcoin going to the moon, going to 1 million, I sell my bag, because there is that, the exit liquidity is called,
for sure.
A lot of people coming in at the back end, at the tail end, and those smart ones, they pull out before, because again, people fall in love with, thinking that they can make easy money and they will continue forever. And we all have that, but we just need to be conscious enough of it to actually regulate that internally,
I guess we can all turn into addicts if we hit the slot machine too often. So
it's like, yeah, exactly. It's like, the expectations of, I'll win and it's like, it's tied to your identity, it's like, oh, I found a gold mine. Yeah. It was me,
Yes.
And then you get tied to that decision and you can't actually pivot.
It is.
We see that in business regularly as well,
That's a very, very good point about the limitations of humans, really.
Yeah. And if you're aware of it, you can manage it. You know what I mean? Coming back to Devonport, what I like is it's very affordable. And that's one of the main precursors of steam or growth. Why did I say steam? Well, I mean of short-term and long-term growth. Because if you're starting from a very high affordability base, it essentially has a lot of room to move. You need other things to be satisfied. And these are the other things, you need supply scarcity and improvement of demand. And this is what we actually see. We see in Devonport, LGA supply dropping long-term or scarcity increasing, meaning less and less stock on market. Short term, it's a little bit increasing, but overall, you can see a decrease in the available stock on market. While on the demand side, if you look on the other side, you see demand being weak for the last 5 years, and yet in the last year, you see a very sharp divergence where demand has been improving in the last year, which sort of reaffirms how we started this session, how you said that people are moving to these markets, So bottom line, holistically, I like the fact that it's very affordable. I like the fact that it's supply scarcity because that's essential. I mean, supply is very important. I like the fact that there's a divergence when it comes to short-term demand. And by divergence, I mean demand is improving. Vacancy rates are low or, neutral 1.1%. I just want to look at the hold periods. Hold periods are sitting at 9 years, which means people actually want to live there, want to stay there. So there is a lot of positives here on the LGA level, which tells me if I approach my analysis from the LGA level, this would entice me to look further, to look into deep dive and to see are there suburbs within that have ticks against the crosses where I found the crosses on the LGA level, such as industry diversification, etc.
Industry diversification. So where's the source data for this? Is it ABS?
So it is ABS.
Yep.
It is ABS, but then we also see it's EDI. So let me just
Okay.
Diversity of employment sectors within region. Moreover, occupational categories commonly associated with elevated socioeconomic standings received increased weightings. So it is an ABS source, but we put additional reasoning layer on top because we just don't pull the source, the number of employment sectors, but we also grade the employment sectors when it comes to, let's say, their purchasing power. As in like and assign weightings to those that are more affluent, I would say,
So I'm going to tell you what we do and what I do at Alaya with Hadi. It is probably in line with the contrarian viewpoints that you just talked about. So we do. Hadi's a whiz at this. Been trained in the school of Matt here. Understands the data frameworks in different locations, and has different theses on different locations and has his own thought profiles there. And it really does drive our decision making. But one thing that we do is focus in on this metric quite closely, except we get a bit more granular to it. And then this is where it's different to other approaches is I think it's important. I'm not going to say everyone should do this.
Yeah,
but
go.
because of our skill sets, like I'm a treasury economist, so he's my partner. We apply our unique skill sets to the judgments that we have. So we weight things differently based on what we think is going to happen. And it's very clear what we think is going to happen. There is no predictive, there is no complete data framework here. It is a little bit of us reading the winds of the world and working out. We think that there's a structural market shift happening in the behavior of property investors, and they are increasingly using data tools. It's getting easier. They're using AI. So because of those changes, people are going to start positioning themselves around these markets. That's how we call Darwin. It was just purely behavior of people. So data frameworks like this, that was important, but it was behavior of people. Now, when we talk about Melbourne...
So when you say behavior of people, how did you determine migration of behavior to Darwin?
Because the behavior of people were looking at certain frameworks. They needed a certain yield, and the type of dwelling that they would be purchasing all looked the same. Property investors were all buying the same things. But they had now had a process of elimination in the markets that they were buying. Adelaide, which previously dominated, was no longer available. So then it left an outlier. The outlier was Darwin. So it was cool. People would start moving because the concentration of property investors that behaved like this used to be this small and then magically became like this within a short time period because of social media and some of the changes that have happened in the dissemination of information. That was just us reading the winds. Now, when you apply Melbourne, so that's one...
I was just about to say.
...macro framework. We did the same thing in Melbourne as well. The Melbourne reasoning was actually completely different. It wasn't about I call that microeconomics, where you're talking about the structure of marketplaces. This one is more of a macroeconomic shift, where it's like when you study the patterns of each individual major metro economy and look up, if you pie chart it and you look up the sectorial analysis of what drives the Melbourne economy, and then you think about one of the big macro shifts in 2024, 2025, 2026, is we're actually changing the interest rate environment from a tightening cycle, an inflation problem over the last 4 or 5 years, to now a problem where it's like that's gone away. So we're moving towards a lower and neutral interest rate setting and potentially even lower interest rates into the future because we don't have an inflation problem anymore. So that's a 2024 story, 2025 story. We've been talking about that on this podcast for a very long time. So what we did next was then work out which individual economies are the most sensitive. What sectors are the most sensitive to interest rate changes? The retail sector, for example, you cut interest rates, you put money in your pocket, you're more likely to go buy a new shirt. Like that happens. We know that. We know the construction industry is very interest rate sensitive. So then while mining and energy doesn't really matter that much. It's not changing the behavior there. It's not moving to the whims of interest rate cycles. But then you start looking at the Melbourne economy and you work out very quickly that it is one of the most interest rate sensitive economies. So its economic performance over that tightening period in interest rates was really, really poor. Part of the reason why is we had 1% of the workforce in retail that had just disappeared. They've gone to the government sector, but they've just disappeared. That's a chunk of Melbourne. You're talking 1% of Melbourne's entire workforce. I don't know the quantum of people, but that's not a small change inside a couple of years. That's going to come back because the interest rate story is flipped. So that then drives our attention to Melbourne. So part of this is us thinking about the shifts that will happen in a macro or micro sense and then applying it here. So if I'm looking at Devonport, you've just gone through a wonderful data analysis. My next step into Devonport research would be two things. One is to understand what are those industries there and the concentration of those industries there.
Absolutely.
Then make some assessments as much as I could, do as much research as I can, and some assessments as to the short-term change in these areas. I'd be looking at Devonport as a 5-year play. Like, I wouldn't be looking at it as a 30-year play because of everything you've just told me.
Mm-hmm.
So what are the drivers of these specific sectors over the next few years? And then I'd be paying a lot of attention to that infrastructure spend there and being like, where is it? What's going on there? Why is that infrastructure spend happening, and how does it play out with this economic cycle?
Yeah, you see, you said of so many great things, and in some instances why matters, and in some instances only what.
Yes.
So, for example, if we talk about, let's say there's been an increase in government spending in, public sector. Yeah. But the public sector purchasing power is still lower because of its salaries. I mean, there's more jobs, there's more public sector jobs,
yep.
But the purchasing power is still lower. So, yes, that sector is expanding, but then we have to take into account the variable of the purchasing power. Okay. In the same instance, if the retail sector is expanding, I agree. And I would approach it in the same way. Next question that I would ask myself is, what is the quantum of change, and how will that affect purchasing power? And you have to go more granular. Now granularity, the devil is in the detail. I love that. I love that observation. And I love that observation because I realized only a couple of years later, because when you go to too much detail, you find the devil there.
Yes.
When you dig too much of a hole, you can't come back out.
Yeah, that's true. Yeah, that's very true.
And this is why, we thought about, okay, the why is very important, and we all built on why. By the way, I agree with every observation that you made. But then how do I short circuit, and how I just look at what, and I don't need the why? And this comes down to, and the way I think about it, if there is a structural shift in purchasing power, and by the way, to give you an example, I actually developed a case study from it in 2024 in April, and luckily I have AI and it has access to all of the articles that were on the web in 2024. In 2024, we did a presentation to Buyers Institute of Australia, and we identified Melbourne. It was April 2024, and we identified Melbourne as the next hotspot. Yeah. Yep. And I looked at the articles that were online back then. It was essentially a witch hunt on Melbourne, Maybe 8 months later, people started talking about Melbourne in media,
Yep.
Yep. So this comes back to, and at the time, the interest rate environment was higher. Yeah, so April 2024, there was no drop. The interest rate environment was higher.
Oh.
There was no effect. Now, this comes back to anticipation, So how did we anticipate without knowing that the interest rates would decrease, which will affect the composition of the economic diversity or the purchasing power of, the sub-economies?
Wow.
It's essentially long-term trends of supply and demand.
Yep.
It's just a what, it's like, I ask myself this question, and let's say infrastructure spending, what is the time frame between infrastructure being built? The radius of people that work on infrastructure project is about 20 kilometers by research, which means that most of the people that work on those infrastructure projects come from within the LGA. Yeah. And then if they come from within the LGA, and there's a couple of stages. There's workers who earn a living. Then there's a stage where you build a hospital, you need employees. Yeah. So there's a couple of stages there. And then my question is, what is the time frame that the higher levels of infrastructure spending will affect the purchasing power of residents, okay, within the LGA? You need to build a project, then you need to increase their ability, and then the ability needs to turn into willingness. People assume that just because I have money, I will buy property. and they conflate ability with willingness. And that's not the case in so many markets. So you have markets where there is an enormous ability to purchase property. Property is very cheap. The wages are high. This is why when people analyze an area from the standpoint of approaching it from wages first, I believe they're doing it incorrectly, because you have a lot of markets where wages are high, properties, very affordable, and yet you see negative 20% growth in the last 10 years. So
it's Darwin. That was Darwin.
Darwin, I don't think he had negative 20. I think some WA.
Not that bad, but
I think
nothing for 10 years.
I had Newman in mind, but there's other Newman in WA, but there's some other areas as well. And what I'm trying to say is that you have an economics background, and I take a lot of interest in that, and I do go extremely granular and do the same thing as you. But the question is, okay, how do you short circuit the search for the everyday user for them to be able to decide without having an economics degree?
It's true.
Makes sense. And essentially it comes really down to supply and demand, to begin with, if there's an increased supply scarcity and the demand is improving, and if the property is very affordable, so I'm adding a third metric, affordability, and while at the same time there's high level of affluence, i.e. socioeconomic standards are better, you already have a perfect storm. You already have a perfect storm, which is sufficient enough to actually produce growth. Now, let's go granular. Let's say, which streets or which suburbs should I buy in on the basis of the economic diversification and main industries within those towns, on the basis of the interest rate drops and the flow-on effects? This is where you get really, really, into the detail of things, which is beautiful, And it's necessary, in my view. It's just that it's a progress of knowledge, But there are a few, variables there as well. As I said, government, the public sector has expanded dramatically in the last 5 years, There's a lot of money being pumped into the public sector, but it doesn't mean that, that money will actually transform into the growth in, areas that are dominated by public sector. Because still they're earning 80K.
Yeah, it's true.
So, and still they're earning 80K, and they still have an affordability issue, not only with the property, but they have an affordability issue everywhere else around them, especially with property, Yeah. So, the retail sector, let's bring it down to common sense. Well, maybe the person who owns the store will make the money, but will the workers that work in that store have a higher purchasing power enough to actually buy the property? Yeah. So there's so many variables there, and the rabbit hole is beautiful, by the way. I like it.
Yeah, it is.
But once you get down into it,
100%,
you're like,
that's
and by the way, it just proves that what you did turned out to be correct. And I know when you said Darwin, I remember the time when you said Darwin. And that was a time when nobody else was talking about it. Internally, we knew at HTAG that it was in the shortlist top 3 suburbs always, And you came out, correct me if I'm wrong, 6 to 8 months ago, yeah?
I don't really know. It's probably a year ago on the podcast now. But it was more, I think it was a podcast.
It was more than 6 months. You're right. It was more than 6.
I think it was a podcast where we just said, hey, this is where I'm going to buy.
Yeah, but see, this is again, the warm spot methodology, let's say the warm spot methodology in our DEX module, not to explain it, which ranks metrics and assigns weightings. In a warm spot methodology, the highest weighting is assigned to yield.
Yeah, makes sense.
But you have 2 types of yield environments. You have a yield area that will never grow, Newman. And it has a 7% yield. It will never grow because it doesn't have the other ingredients, like the industry diversification and many others. And then you have the other yield areas where the yield is high, while it has all of the other ingredients, and it's actually more sensible to own a house, Darwin.
Yes.
So it is very clear, that it was the main choice. And the narrative online is that the most purchases in Darwin are happening by investors.
It is, yes.
I'm not so sure.
I wouldn't say most purchases, but there's been a big shift in the number. So you can use ABS lending data that comes out quarterly for this and just see the composition of the number of investors that have purchased on a single transaction item. And if you go through 10 years of history, through to 2024, you have it's volatile, but it's maxed out at around 280 to 300. And then in the first quarter of 2025, it is above, it skips 300 altogether. It's above 450, and now it's above 500. So what has happened for in individual quarter, in these 2 quarters, to be more than double its 10-year past every single quarter?
And then the interesting thing is that how will that affect the owner occupier base?
Yes.
That's
strengthening too.
Do you have a FOMO aspect in an owner occupier base where, okay, the property is increasing, it's being pumped, I should buy a house now because otherwise I'll miss out.
100%.
And then you get this carnage essentially, which is a hotspot.
Yes. I would say Darwin is very much a hotspot now.
Well, it's not reflecting those growth rates in the last year, but
quarterly it is though.
Yeah.
Yep.
Quarterly or monthly, it's it's showing like great momentum. I usually work on a year. I say a hotspot is an area that's generating 10% or plus a year, because usually
how many years?
I look at the last year. I look at yearly. So
cool. I think that was just past 12% just now because it's last monthly because it's growing at 2% a month, right?
You're talking about mediums. Yeah, you're talking about medium values. Yeah.
Medium values.
Yeah. Okay, so we use a typical price, which is a adjusted revisionary metric. Not to go into it, but
it'll get there within another few months.
Yeah. So and it's usually the reason why I say above 10% is because that usually corresponds on the ground as 20 offers on the same house.
Yes, that's what's happening. That's what's happening right now.
Yeah, exactly. And I mean, a hotspot is also the 25%, the 30. The Burdells, the Mount Louises,
Yes.
Yeah. So I mean, there's a lot there. There's a lot there that you said, and it's very interesting. And the weighting of and you're right. I mean, we also realize that. Well, I can't just tell you how many industries there are in a town. That's insufficient.
Yeah.
Because it doesn't tell. You need to assign some kind of a weighting to an industry, and the reason why we went down the purchasing power route is because, you're thinking, they have more money to actually, afford a home, but there are nuances within that as well.
So I probably play, especially in the BA space, in the layer space, I probably play business is different because we do play to our strengths. And if I'm there involved, the strength is you've got an economics mind that comes in and looks at things a little bit differently. It is the way our brain works, and it's our own thesis and our own ideologies being put in place and utilizing the wonderful research and the data synthesization that HTAG has, and then putting in our own flavors here. So
let me just, before you say that, and just to say, when I say that nothing is perpetual, that also implies that nothing is complete.
Yes.
Which means that you can have wonderful tools, but if you have additional layers of reasoning and the input and your experience and all of that, this is when a tool becomes magic, So I agree with you 100%. Yeah.
And if I had to describe it, this is your tool, HTAG. I say this, I've said this many times to our audience. It is magic to me because our entire team use it. And how do I explain this? When you show all of this to 10 different people, they may have different opinions. I think 5 or 6 of them may find it a little bit that they may just be parroting what they think and what they repeat. But then a couple of people will look at this and have a slightly different thesis and hypothesis and look at the next layer of research differently. And I want to actually throw 3 layers of research that we put in very, very closely and I look at all the time to help me work out exactly what is happening, why it's happening, and what is it supporting the theses that we have. So one of them is that housing finance data that I just talked about, because it tells me where investors are buying in a geographic location and tells me where there's odd
anomalies
in the lending space, and that comes out quarterly. We look at jobs growth data as well, and again it's quarterly change. It's actually monthly changes. So the Labour Bureau of Australia has the employment growth statistics, and I don't care about unemployment rates anymore. It's kind of useless because it's too aggregated and includes so many different metrics. I care about employment growth, number of people in jobs at the moment, and more people getting jobs, and how many people are losing their job at an individual level in an individual location or SA3 area. It's another one that we look at very closely because it again trends to the economic performance of of an individual.
Absolutely, yeah.
And then there's the third one. This one I find a bit messy at the aggregate level, is the actual GDP data of that location, and looking for change in that. And then there's the drill down of the components of that change. What are the sectors that are creating that change? I just touched on the Melbourne one as an example over the past few years. Those three metrics, would those appear in hashtag in any framework, or is that like one level above what?
So interesting what you're doing there. You'll find out, the more it's an iterative process, You'll find out that job growth doesn't correspond to property price growth.
Agree, yeah.
And job growth does correspond to property price growth, but in some areas it does so in 2 years, in some areas it does so in 4 years, in some areas it does so in 7 years.
Yes.
And when you're talking about a portfolio building process, you need to consider the timeframes of when to put and where to put your clients,
Yes.
So this is what I call, a sprinkling exercise. Let's say you have a steak, you cook a steak, but in order for it to taste well, you got to, put some salt on it. You know what I mean? So you have to decide what comes prior, Let's assume that there is a job growth in a particular area.
Yep.
And this is why I've really emphasized, and this is what's really important for people to understand, is that ability does not imply willingness. Think about it. Ability to buy property does not imply that I will buy it. So it's very important. And this is why I'm saying there are many instances within which you have a purchasing power in a population or SA3 region, and yet the growth is not there, for whatever reason. So if I'm going to ascertain willingness, so if I'm going to look at job growth and purchasing power growth and want to see whether there is willingness, well, simply I need to look and see a reducing days on market.
Yep. That should come out though.
Yeah, it should transfer. It should transfer down
100%,
to the willingness and actually property spending less and less days on market. That's
the magic. You're talking about the magic though, right? With the macro analysis, it's useless without the magic. Your tool.
Yeah, it needs to be connected. It needs to be connected. Yeah, absolutely. And it comes down because you're right. It comes down to choice.
Yep.
Because choice implies multiplicity, i.e. many suburbs. Yeah. And then if you have to choose from two that are very similar, but then you realize that some pockets have, improving GDP, all of those three layers, of course you're going to pick that one, because it's like you're ticking more boxes and you're increasing the probability of an outcome. The thing with detail is what I realize is that detail is very hard to then extrapolate onto a reasoning layer when it comes to time frame. How long will something take? How long will something take to take effect? And then you have to revert back to the basics and say, okay, well, simply, if there's no property to be bought and yet people want to buy property, the price will grow,
Yeah.
So, it's the infrastructure spending again is an interesting one, it's a top down or bottom up approach, however you want to do it. But I think that additional layer that you're doing, again, provides your clients, they can sleep at night more, They can sleep at night more because you're adding these additional reasoning layers that prove, okay, this is the best option that we have at this time, So but it's like, how do you make it? It's like the catch-22. How do you make it simple enough and yet complex enough for every user to use? Yeah.
I feel like that's a line that you would have to be debating a lot when you're building up hashtag a lot and working out.
Yeah. So, and to answer your question, sorry, do we have that data? We do have that data, and that data now comes, which is why we're building our own AI modules. We spoke about this before, which means that now you can access information that might not be presented as a metric, but you can access information to overlay your analysis, like that detailed information is in, the growth is an equation of liquidity, aging population, and increasing population. at least growth in equities, you know.
Yes.
So, but in property, it's the same thing. While in property, you have the wealth transfer of the aging population, so it continues, you know. But what I'm saying is, you know, for example, I was researching for HTAG the other day, and I came to 2 suburbs that are very close. And then it is these questions that you ask, you know, what is the aging population in this area? Because I know they're going to go on the pension. You know, will they be purchasing property? They won't be purchasing property. If it's 40% of the population, well, the growth is going to be stifled, even though you know what I mean?
Yeah.
So you ask this and pull all of this data from various sources into a single interface while you have all of these other statistics as well. So yeah, we do have it.
So powerful.
Yeah.
It's so powerful. Being able to synthesize that information as quickly as you can today. Because like, if you think about it, we're humans, right? We would begin our research on one thing and be like, it's taken me a week or 2 to actually get my understanding of this marketplace.
Absolutely.
Right? Now we could do it in, you know, it could be a 30-minute exercise to go through one particular location. We've talked about one location in this, probably not going to get through 5. We talked about one specific marketplace in here, and, you know, it's given us a really good flavor to this Devonport market. Can I get a conclusion from you here? There's so much richness in this data, and there's things pointing in different directions. If I had to get you to classify this as cold, warm, or hot, what do you see Devonport as with the frameworks that we looked at?
Devonport, well,
Is that a hard question?
you put me in a bit of a spot now, because it's not actually a hard question. It's an interesting suburb. It's an interesting, LGA.
Yeah, it is.
It has grown in the last, you know, well, the data confidence is medium, so I have to question its growth, but it's growing while the other, I'll classify it as a warm spot.
Yeah.
I'll classify it as a warm spot. And what is a warm spot? A warm spot is an area that will deliver 20 or 30% growth in the next 4 years when you add it up, not accumulated, when you add it up. You know,
it's pretty good.
So, which is, you know, which gives you the substantial amount to refinance. So that's how we frame it. We always frame it as an equity extraction exercise. When do you need to extract equity, given your serviceability to leverage into additional assets, you know? So that's the part of the story. And then the other part of the story is, you know, how to anticipate, you know, I don't care about the equity extraction, but I want to be in first. And this is where you go to the warm spot anyway, you know, you try to find those markets that are positioned for growth.
I think it's worth having it on investors' watch list and looking into it. Whether you purchase there or not, I don't know. There's many more layers of research to do. I talked about some of the work that we do before looking into this specifically, but it'll be there. It's worth looking at.
Absolutely. And as I said before,
pro factors.
We looked at the LGA. The LGA, you're not going to purchase in an LGA. You're going to purchase in a suburb, ultimately.
Yes.
So this is what I always say to our users. I say you go as close to the purchase point as possible in order to understand what is happening. You know, there is an assumption that, you know, people assume that just because there's a lot of building approvals here, it will dampen the growth in another suburb within the LGA or something like that. They try to connect, and which implies that they assume that all suburbs within the LGA grow at the same rate. Well, I think a thought exercise for all of our users is, you know, go on some platform and look at your LGA and look at growth rates of each suburb. You'll be very surprised. One would have grown 150% in a decade. The other one, in LGA that I live. In an LGA that I live, you know, Oran Park has grown 220% in a decade, while Catherine Fields has grown -10. Do you know what I mean? So that's what I'm saying. When you're looking at an LGA aggregated level, you don't actually see the nuances. Yeah. And just from the aggregated level, I can right away see that there are great suburbs in Devonport. But you know, not every suburb, that's why it's important to inspect further, because not every suburb grows at the same rate and has the same dynamics, you know. Like, obviously, we all know that some streets have better growth rates than others when you go granular, you know what I mean? Because of the appeal, you know. Yeah. So the same applies to suburbs.
For sure.
Yeah.
That's awesome.
I'm so sorry that we haven't gone through the other ones. Yeah, we got heaps.
I wouldn't mind your take. Maybe we don't have to. I feel like we went through the frameworks, which is actually so important for everyone listening here, because you can go to these suburbs yourself, get on HTAG, go on the tools there, go into these LGAs, go into these locations, and then you can start looking at them. And we've talked about the frameworks to help you work out how to do it and then put your own flavor onto it. So that, I think, is more important than us actually going through each of these suburbs.
Yeah, absolutely.
Line. Teaching someone to fish is better than just getting the fish for them. That's kind of the premise here. But if I can, really, really quickly, if I go through a minute on each, can I get your thoughts on the Bendigo LGA? And I want you to give me, in a minute, what you think, and then end it with warm spot, cool spot, hot spot.
Bendigo. Okay, so Bendigo. Let me just see quickly.
This is the mad level skill you can have if you do this for a living all the time and look at these charts all the
Yeah,
time.
so Bendigo is a bit better than Devonport. It's better than Devonport because it has better socioeconomics. It has same affordability. It has more improving short-term demand and higher supply scarcity currently.
Wow. More market pressure.
So more market pressure. Yeah, that's why. So the ERSAT is 6, socioeconomics is 6, it's elevated. Remember, Devonport is 2 on an LGA level. So way ahead. The steepness of the slope and the supply scarcity is decreasing dramatically. Also, the days on market, 3-month rolling average is 35, which is approaching, a hot territory. And what was I about to say? Overall,
what's its 12-month growth?
And it has, sorry?
What's its 12-month growth?
12 months, it's been less than Devonport, 4.32, but I will pick Bendigo.
100%.
Yeah.
So would you warm spot then?
It's still a warm spot. It belongs in a warm spot, but this is the thing. Warm spots and hot spots last anywhere between 1 to 4 years. So you can have a hot spot that lasts 8 years like Townsville, or you can have a hot spot that lasts 2 years like South Gladstone, So it depends. But on average is 1 to 4 years. So even though Devonport has seen more growth in a typical price in the last year, I think that Bendigo will deliver more within the 4 years, but they both belong in a warm spot territory.
Very interesting.
Yeah.
I'm not surprised by that, Isad, because Bendigo is one of the richest cities in the world, actually, in its historical past, about 100 years ago.
And it's got a very high infrastructure spending as well, by the way, nearly 2,000 per capita.
It's a gold city. Have you been to Bendigo?
No, I haven't. No.
It's a gold city. So it's where our gold fields were 100 years ago and where Australia's store of wealth was.
Yeah.
And when you go there, you see it looks a little bit like St. Petersburg or Russia. It's just, what is this? These buildings are insanely beautiful. And
really?
It's in the middle of Bendigo. When I'm there, I'm like,
I must go then. Yeah,
it's very strange.
Yeah.
You can feel the history. It's strange. You can feel the history of wealth.
Yeah, okay.
Okay. Isad score making.
So yeah, I would choose, if I had to choose, I'm choosing an LGA, I would choose Bendigo over Devonport.
Let's go Geelong.
Greater Geelong. Okay, Geelong. More of a warm spot. Quickly. Okay, Geelong. Interesting. So Geelong is a higher price market, and it doesn't actually fall into the same brief as would Bendigo and Devonport.
Yep.
Because Geelong's typical price is much higher. It's like at around 800K. So it's like comparing apples to oranges, Geelong has seen minimal growth in the last year, so it's sort of warming up. What I like about it is that, it has enormous infrastructure spending. It's a larger town. Its ERSAT or socioeconomic is elevated. The issue, for example, with Geelong is that Geelong also is positioned for growth because it hasn't been outgrowing itself for 2 decades, talking about the growth pattern deviation before, so it's ripe. It's less affordable than the other two that we mentioned, but it's less affordable because the price point is 200 or 300K different, So
got strong enough ESAD to continue to grow though, right?
That's right. So it's got, but see what I would do, for example, is, I would go into to alleviate the affordability pressure. Geelong is a great opportunity. And I would buy a 3-bedroom instead of a 4-bedroom, Obviously, I will look at a demand profile and see whether 3 bedrooms are in demand. But this is what I do as soon as, which they are mostly in demand, which means that, 3 bedrooms are 700K, which means that the affordability index would sit at 35 years, which means it's very affordable. ERSAT is very high, 8 out of 10.
What's market pressure like at the moment?
Market pressure, very similar to Bendigo. We see supply scarcity increasing both short-term and long-term, and we see a divergence in short-term demand, i.e. long-term demand was weakening, but short-term demand is dramatically improving. And actually, 3-month rolling average is sitting at 31 days, which is reminiscent of a hotspot, So while it has seen less growth in the last year than Bendigo. So see, this is where I see opportunity. I see, okay, this area has supply scarcity, has much better improving demand. I pick a 3-bedroom, which makes it more affordable. It has a very high ERSAT, and yet the growth momentum hasn't started moving yet. So I'll enter now before it does start, But again, as I said, it's apples and oranges in response. But looking at it, it's very interesting that its dynamics are very similar to Geelong when it comes to supply and demand.
So warm again? Or
it's warm. Everything in Victoria is warm, warm or transitioning.
Yeah. And
warm.
This one's putting you on the spot a bit, but between the two, I know you're comparing apples and oranges. Is this just simply if your budget allows for Geelong, maybe you want to look at it? If your budget allows for Bendigo,
if your budget allows for Geelong, I would look at Geelong. Now, again, on the LGA surface,
yes, for sure.
Because you might find suburbs that are better in Bendigo than in, on the LGA surface. I would look at Geelong simply because it has much higher socioeconomics. It hasn't been outgrowing itself for 2 decades. And I would buy a property that's more affordable, i.e. either a 3-bedroom house, which is very a lot in demand. Now, the affordability is higher in this instance, or unaffordability is higher than the other 2 areas, which means that you'll sort of hit a ceiling at some point, but you have an ERSAT of 8, So that ceiling might be 1.4 mil, or something like that, So actually, very similar. Bendigo and Geelong are very similar. It depends how much money you have to spend.
Both are high on the liar watch list as well. We like Geelong, and we've talked about this. We've talked about it as the 2026 growth story. So a little bit of early positioning. I think we said that a few months ago. One of the markets that would do very well is Geelong, as more and more investors get attuned to this. But the reason why we actually like Geelong is a little bit, again, it goes to those shifts that we talk about, the economic shifts that we talk about. This is us theorizing a little bit and then working out what changes we expect in the world. One of the changes we do expect to see over a long time period is, and this, different people will have different theses on this. So you, as the listener, pick your own mind. This is our argument, is that we see a world where humans are putting more time into leisure than work into the future. That's probably the AI shift of a 20 to 30 year period. That's something that we think about of how society will change. And then we think of where Geelong is strategically placed compared to Melbourne, where it will be the largest population centre of Australia. Then we think about where do people want to live in a leisure environment. If there's a huge concentration of people in Melbourne and Geelong is 1 hour away from there, and anyone who's been to those 2 locations can go very quickly to Geelong and go, my God, I want to live here. It's like Bondi. It's insanely beautiful. It is a lifestyle hotspot. It is a rapidly growing population. It is affluent, but it's only an hour away. And you think of the societal change over that time period. I think Geelong over a long, long period of time will benefit from structural shifts to Australian society. That is why we have a long-term view and a short-term view. It's just like there's an opportunity to get in now because of the market cycle timing, but you also benefit from some of the structural changes.
I agree. And the structural change is also diversification. I think Sydney is a great example, Parramatta has been built up or propped up as the next CBD, because, they want to diversify, I guess, economic centers in Sydney, and this is why you have Southwest and the Southwest Airport and all of these other things. So it is that also structural change that will affect Melbourne as well, because you don't want a concentration into a single city. You want traffic is one example, but there are many other reasons as to why, governments want to diversify economic centers.
100%. Yeah. That was our take on Geelong. Bendigo is also really high on our list of purchase prices. There's actually a few suburbs that we rule in and rule out. So we do the suburb level analysis. That's the hashtag magic. Everything that I add and everything that all the frameworks that we actually don't go down to suburb level. So I don't, we talk about a framework a little bit when we talk about everything that we do. It's like a little bit like a triangle. So we begin by the theses of what we see happening right now, happening to the world, happening to the individual marketplaces, the micro marketplaces, the behavior of the players within that marketplace. It's a broad economic understanding of what is driving these data changes over time. That's the starting point to it. It is theses, it is ideas, it is informed thinking. But at the end of the day, it is ideas. That's whether they're right or wrong, you work with who you want to work with. This is our approach. And everyone has their own choices here. This is what we do a little bit differently. And then from there, it is looking into the LGA type analysis and kind of applying these thesis ideas and trying to look for areas that will do or benefit from those. Melbourne, for example, with those economic changes that we talked about, Darwin with those structural changes, Geelong with the lifestyle framework where I'm talking about long-term. These are all the frameworks. And then this is the part that I actually don't play that much of a role. I get asked a lot, a bit like you. You are a master at this, not me. I get asked a lot is then tell me the suburb. And I'm like, cool, that's the part for the data experts. And that's where Artie plays a role, kind of similar to the chair that you sit in, where it's unpacking all of this into an individual location.
Yeah,
so that's kind of the framework of how we get to where we
Well, I can just, I don't use your framework, but I can tell you that your framework is correct. And do you know how? Geelong's typical price is 870K. Well, I don't know what Melbourne's is, but it's not far away. It's probably a bit higher. But what I'm saying is that, deliverability factor obviously plays a role.
Have you been to Geelong?
No, I haven't. But I'm saying, if it was a decentralized city with no value and lifestyle value, you wouldn't have a 5-bedroom property worth 1.2 million, which it is. Yeah, 5-bedroom property is 1.2, 4-bedroom is 944K. So that's more than Karoom Downs.
Yeah, it is. This is something a bit wild.
And Karoom Downs is GCC Melbourne, yeah?
Yeah, it is.
Yeah. So it just affirms the rationale that there is a lifestyle thing there that draws,
So I people know this about our audience. I feel a bit privileged, done fairly well in my life, grew up in Western Sydney, to some troubles, and then
I'm still there, man.
Done fairly well. Yeah, I love it. Absolutely love it. It's heartland. It's who I am. Grew up with some struggles financially. That's the story that I have. But now have a bit more choices in my life. And a lot of Sydney-siders have these choices as well. A lot of well-off, well-to-do people have choices as to where to invest. I actually think Geelong is so nice that people with choice will be like, I don't think this is now. This is not an outcome.
Yeah.
This is a hypothesis into the future. It is going to become a little bit like, this is probably a stretch too far, but a little bit like the concept of Byron, a bit like that, where it's just like, it's different because of its natural topographies and things like that. That drives Byron, but a little bit like that. And a little bit different because it's got 8 million people, maybe 10 million people into the future, maybe 15 million, 12 million, whatever it is, an hour away, a lot of them really, really wealthy, and being like, cool, where do I want to spend my weekends? Where do I want to be? I now have more time to myself. Where do I want to live? Geelong's going to increase in its population growth because of that. That is probably one level further in the triangle.
Yeah, that's a long-term gain. Yeah, that's a long-term gain. Yeah, absolutely. Yeah.
What's the last two we've got here? Oh, everyone wants to hear this.
Darwin.
Tell me your Darwin take.
Well, Darwin, this is the thing, and I'll begin with this. Everyone talks about Darwin, and Darwin did appear in our shortlist a long time ago, but this is where it comes to, Darwin is very important when it comes to suburb level, because most of the suburbs of Darwin are bad. There's only a couple that I really like,
What are they?
Sorry?
What are they?
I like Durack, for example.
Yep.
Durack I really like. Zuccola has been popular, but I like Durack more. But other than that, there's some other ones that are popping in. I can't remember now but Durack has been popping in, for example, for about a year now in our shortlist.
Mm-hmm.
So Darwin is really diverse in a sense that you have really good choices and really bad choices. There's no middle ground. And this is why when people say Darwin in general, I'm very cautious because I hear that, people are purchasing in some suburbs in Darwin that I wouldn't touch with a 10-foot pole, So
why is that? What would drive?
Because it doesn't have all of the things that we've discussed. It doesn't have, the affordability, the socioeconomics, the supply and demand, the industry diversification, the everything that we've discussed. It doesn't have it's more of a speculative play. I mean, if you're going to invest, by the way, a caveat as well, you can make money in any market.
Yeah. Yep.
So that's also a mindset that we have to have, you know. I find the house that's run down, I buy it under market value, I renovate it, I make money. I make 150K. Great. And I make it in a declining market, you know. But I'm talking about market momentum, you know. Some suburbs have much better market momentum short-term and long-term in Darwin than others. And the gap is actually wide, you know. So
interesting take that one is.
Yeah, so
I wouldn't know that without looking into this specific.
So 3.3% growth in the last year, typical price, not medium, yeah. Again, the industry the risk score is very low, meaning, you know, exposure to negative environmental effects and industry diversification.
Can I throw something?
Yeah.
Interesting thing. Sorry to interrupt you.
Yeah, no, go for it, bro.
The typical price, can you explain that for a second? 3.3% in 12 months in Darwin. So what do you mean by typical prices there?
Typical price is a metric that we've developed, and there is an article published online that we've developed at hashtag to represent more accurate movement of prices. So to give you an example, imagine medium. If you look at a medium chart, it goes like that. And with hashtag, it's all about predictability, you know, and you have a lot of outliers. So a typical price is an algorithm that first considers the outliers, cleans the data, and it's also revisionary. So it takes into account what has happened in the past and revises its trajectory to make it more accurate for you to see where the actual trajectory is going, you know, because if you focus on the medium, it oscillates a lot. And essentially when you zoom in, it's like a 15-minute chart on equities, you know. It's messy. So it's like, because with hashtag everything is predictability. So how do we develop a metric that tells you direction more, you know? Which is why you see, you know, when people start comparing two different methodologies, you have to understand how the methodology is built to compare and say, you know, somebody let's say Darwin is growing 12%. Well, they're using mediums. They're not using typical price. Now, it is a very complex metric. It is essentially a data science aspect to our platform. And there is an article on the website that explains exactly and does the comparison. So shows the medium, shows the typical.
If I had to unpack what I know on the ground and bank values and things like that, like, you know, Adi, for example, he bought in Darwin at the beginning of the year. And if I bank value his property and then just put it straight,
you saw 150K extra.
Yeah, it's much more than 3.3%.
Yeah,
but But
that's a suburb. Yeah, we're looking at the LGA.
Yes. Okay. That makes sense. If I pull that across 100 different Darwin purchases, I'm going to see significantly more
in the
growth than the 3.3% in many different markets. So, but can I explain why I think that might be the case and why it's there in the data? This is also appearing in loan size data as well. Is the actual purchase price in Darwin, the actual transacted sale price in Darwin has come down, even though the market volumes and prices that people are paying are obviously up on the ground. So why are those two things happening at the same time?
Yeah, so this is why I said that Darwin is an interesting thing, because there's no middle class of property, you know.
So
it's like you have the great suburbs with great growth, and then you have something that I wouldn't touch with a 10-foot pole. And when you aggregate that on a suburb level, this is why you get a lower average. That's what I'm saying, you know. And it's also a different methodology, like it's typical price, not median. So, and we believe the typical price is a more accurate representation where the price sits, not because, you know, it's ours, but because we actually invested a lot of time in building it and developing it, and we published our results and compared the two as well. Like there is an article that compares mediums and typicals and shows examples. And Alex would be more skilled to talk about the actual data science aspect of this, my co-founder. But the reason why you see this, and I know many individuals who purchased in Darwin, you know, and are now, you know, sitting at 150K gains or something like that, you know, within 6 months, I would say. But it's because they purchased in certain suburbs, but not all of those suburbs had the same growth, which sort of aligns with what you're saying, is that the loan book, looking at the loans, the price of the property is going down in some areas.
The reason why is actually because investors purchase. Darwin's a very, very rich area, like income-wise. So the actual typical price that people buy at when investors aren't there, you know how I said last year, investors per quarter, 800 per year, call it 1,000 per year, investors purchase. Now this year it's going to be 2,000. So big change. In typical environments, owner occupiers make up the transactions that happen in a single year.
Absolutely. Yeah.
Owner occupiers purchase more of those transactions, which means that the total price point that's trading is higher. But now that's completely flipped. It's like there's so many more investors than usual, and the owner occupier who's buying at $1 million, that is making up less of the concentration of the data and the investor amount. So it's pushing the price. It's pushing the some of the data metrics a bit messy in a small market like that.
Yeah, I think, as I said, and you know better, like I think, 2/3 of loans are, obtained by owner occupiers across Australia, So now, of course, you have segments within that. Darwin probably will be different, but, I think, I don't think we're going to have a scenario where 80% of purchases are done by investors for long periods of time.
Yes, it's temporary. Yep.
It's going to, bottom line, just to quickly just skim through what I like about Darwin, very high infrastructure spending, industry diversification is, I guess not perfect, has a very high ERSAD socioeconomic score, and it is very, very affordable. I mean, those are the two things that I always look for, both short-term and long-term steam,
They make more money than Vaucluse people. Did you know that?
Yeah.
Rose Bay.
Yeah.
The Darwinites, they do. I looked at it. I had to look at it 3 times. There's something wrong with this?
And this is exactly, and exactly. Like I looked at Durac. Durac the quality has an ERSAT of 10.
Yeah.
Which is the Vaucluse thing.
Yeah.
And the affordability index, or how affordable the property is,
so good.
It's like affordability index is 28. And for the listeners, it's like saying, a house costs like, like a table in Darwin, a house in Vaucluse called, it's just like, it's very, very, what does that tell you? You know what I mean? Like you have a lot of money sitting on the sidelines. It's very affordable to buy a house,
Your Darwin theories are so interesting because I've done it a completely different way to you. Not this way. I actually did it by picking up the phone. I spoke to about 20 people in Darwin before I released that. About a year ago, I released, this is what I'll do. I said, I'll buy 3 things. I'm pretty sure the 2 things are I'm buying Darwin property, and people looked at me like you're an idiot. Well, what the? Yeah. I didn't expect that one. You never talked about Darwin. And I also talked this yet to be proven wrong about this. Today I'm wrong, right? I don't think I'm going to be wrong in a few years' time. But today,
you're not wrong. You I know your clients made 150K from purchasing Darwin.
The Darwin bit. The other one, there were 3 different examples. Yeah. I said that buying cheap units in Melbourne would make sense in the future. Now, that was a completely different reason. It's actually not a data reason at all.
Yeah.
I don't recall the third one. I think it was just Melbourne houses. That's the third one, which for now hasn't really proven to be true. I can tell there's market momentum on the ground. I think you know that as well. But right now it's not proven just yet. People haven't made $200,000 in Melbourne just yet. That's probably in a year or 2 potentially.
The issues are the yields that you said in Darwin don't exist. Yeah. So yeah.
So many interesting insights here. So Darwin, hotspot, fair to say now?
I wouldn't say it's a hotspot because it's improved. Well, given on an LGA level again, it's a hotspot. It's a warm spot transitioning to hot, like it's in that transitioning area. I would expect, on the LGA level, again, LGA level is going to be difficult for Darwin because you're going to have 2 horses pulling the carriage of, another 50 horses in the back, So you're going to have 2 suburbs that are doing phenomenally great, or 5. And the other ones. So on an LGA level, it's a warm spot. But see, this is the thing, how you have these markets within markets,
100%.
On an LGA level, it's a warm spot. It will generate 20% in the next 4 years. But we've already proven that on the suburb level, that 20% has been generated in the last 6 months,
Sure.
Because again, and this proves exactly what I say, because Darwin is really divided. Just when people say, and this is very important for listeners, when you say Darwin, you can't buy anywhere in Darwin. That's very important because you will buy in an area that is wrong, and that's all I say.
It is. I think that's important to do. And my research with those conversations with Darwinites picked that up as well. And I feel like the areas that we have in mind will be the same areas they mentioned because it is the on the ground element, and that is a bit of livability component.
And see, just to we don't have enough time, I don't want to talk for hours and bore you, but how people usually say, on the ground, there's data and there's on the ground behavior. You know, you and I came at the same conclusion for Darwin. You picked up a phone call and you spoke to people. I looked at data. Now, what is the crossover between that?
Yep.
Well, your phone call and the actions of the people that you were speaking to were generating the metrics that I'm looking at on the page.
Exactly. Yes.
You know what I mean?
Beautiful.
So the behavior is actually connected,
Beautiful.
but you know, you can do it both ways.
And you've and you've nailed Darwin. It is being much more mindful and looking at that marketplace for what it is, and it is different to other parts of Australia.
Yeah.
So it needs to be taken in there. One last minute, can you quickly go through Albury, another market that a lot of property investors are looking at the moment?
Albury,
And tell me where you think this
hasn't grown much in the last year. It's minus 2%. It's not that diversified in economy as well, but again, it has a high ERSAT of 8. Never been below 0 in the past, apart from 2024, which means the compounding was doing its magic. Spent nearly 200 months in the positive growth zone. It's ripe for a next cycle of growth because it hasn't been outgrowing itself for the last 2 decades. It is very affordable it's very affordable. It's actually more affordable than Geelong, considering the price point, because its price point's about 900K, while the affordability index is lower. Let's look at the supply and demand. Supply is very scarce. Demand is improving short term, but not dramatically, because days on market is still sitting at 81 days. The longer the days on market, the more property sits on the market, which means from the vendor perspective, you know, they're going to come into a position where you can negotiate them down, you know.
It seems cooler.
Yeah. So this is a cooler market, I would say.
Yeah, it seems cooler.
Yeah.
Cool. I'm glad we went through it because it kind of shows a slight difference. Some of the reasons why we picked up as cooler is there's a little bit less market pressure. Days on market is still very high. It's taken nearly 3 months to sell a property. That suggests that there's not that much pressure there at the moment. Matt,
correct.
This was absolutely brilliant. I learned so much. I think our audience picked up so much. Your brain is insanely.
Come on.
It's fun to talk to you. It is really, really fun. And I have said it on this podcast before. I'm a property addict. I love learning about property. I think each of you watching this is, because that's why you're watching, of all things. And I'm pretty sure all of us can say we picked up a lot from you, Matt. So thank you so much.
Thanks a lot, man. Thanks for inviting me. And I really enjoyed this, and I love the opportunity. I appreciate it.
Pleasure.